Today we're looking at bonds and bond valuation. When people talk about valuation in corporate finance, usually they're talking about equity markets, and that's not a big surprise because equity markets of the two are seen to be far more glamorous, far more interesting. Equity markets are reported on a minute-to-minute basis. As stocks trade, they're constantly revalued according to the markets. Bonds don't have quite that much excitement. We see bond pricing is done not on a minute-to-minute basis, but on a daily basis. And many bonds, we don't see reported price change from day to day because they don't trade as actively publicly. However, that does not mean that bonds are not important. In fact, we see that the worldwide market for bonds in 2019 was approximately $103 trillion compared to the worldwide market for equities, which was only in the range of $75 to $80 trillion. Now, of the $103 trillion in bonds that were traded worldwide, only about 25% of those were corporate bonds. The remainder were government bonds, municipal bonds, state bonds, bonds that were issued by public institutions like mortgage organizations. So that may be part of the reason why we hear a lot less about bonds. It doesn't necessarily mean that bond valuation is not as important. In today's session, we're going to take a look at what bonds are and how they work. We'll explain some of the features of bonds. We'll have a quick overview of how to calculate the prices of bonds. Take a look at the bond valuation process. Take a look at some of the measures of bond valuation, including things like yield to maturity, call and yield to call, and the return to the entire horizon. And we'll take a look at some of the reasons why bond prices change. And to do that, we need to get a general idea of what the process of bond valuation is about. Essentially, like everything else in finance, we're trying to figure out what the value of something should be, the intrinsic value. We know the price that something is selling for to determine what the price should be and whether or not that asset is overvalued or undervalued. We need to find an estimate of what we believe the value to be. Like everything else that we look at in this course, we're trying to understand the present value of expected future cash flows, discounted at whatever the appropriate rate of return is. So in order to do that, we need to know three things. We need to know about the expected future cash flows. In this case, things like the interest that's going to be paid on a periodic basis, plus the price that we're going to receive when we cash in the bond at the end of its life. We'll also take a look at the timing of those cash flows. How much of the returns will be during the life of the bond as we receive the interest, or we say the coupon payments, and how much will be at the very end of the life of the bond. And of course, we need to know about risk. And for that, we have the discount rate, the required rate of return, which in this case we describe as the yield to maturity. Bonds are essentially an IOU, a promissory note issued by a business, a government, or perhaps a foreign issuer. Every type of bond differs with respect to the risk and the expected return, the timing of return, and there are many with special features. Government bonds are essentially the least risky, especially those that are issued by countries which have currencies that are stable enough to be able to provide a guarantee in that own currency. For example, for Canada, the United States, the European Union, Japan, countries like that regularly issue in their home currencies. That means that there is essentially only one risk, and that's the risk of inflation. If the government promises that they will give you $1 million in 10 years' time, you know that they're going to be able to pay you $1 million. What you don't know is what that $1 million is actually going to be good for. Will $1 million in 10 years' time buy you a cup of coffee at Starbucks? So the question is, what is the value of my asset after inflation? Everything else can be guaranteed. Governments can always find another $1 million. They can always put on an extra shift at the printing press, make some more money. But again, more money in circulation means more inflation. For businesses, we have also got a risk of inflation. We have a couple of other risks, but most importantly, there's a risk of default. Now, there's a chance that the company is going to fail, that it will not be able to pay its bills as they become due. If you're investing in foreign government bonds, there's also going to be a foreign exchange risk. If you if you're a Canadian investor and you're investing in Canadian dollar-denominated bonds, you have essentially no exchange risk. But if you invest in other currencies, there's going to be a risk. The term that we use for these Canadian dollar-denominated bonds is maple bonds. Other currencies have got names or countries have names for their currency of bond. For example, if you buy a Japanese yen-denominated bond issued outside of Japan, it's called a samurai. If you buy a bond that's issued by the British government, that's a bulldog. If you buy a bond that's issued in Hong Kong, denominated in Chinese renminbi, that's called a dim sum bond. In fact, if you buy a renminbi-denominated bond that's issued anywhere else outside of China, they describe that as a panda. So these are bonds that have been issued to provide an opportunity to invest with a very specific type of currency exposure. Now, let's take a step back and take a look at what bonds are and how they work. Traditionally, bonds were issued on a piece of paper. This is an example of, an older style of bond with relatively simple features, just something that I found on the internet. In this case, the issuer is called the Georgia Public Power Supply System. Not a surprising issuer, it's a big company, needs to add capital in large increments. At the time that this bond was issued, there was deregulation happening in the United States in the power supply business, and so, especially in the southern states, utility companies were increasing their capacity so they could sell into other states. So Georgia Public Power Supply System is the issuer, and it's their promise that they will repay this bond when it becomes due. The date that it becomes due is called the maturity date, and in this case it says at the top, on the first day of March 2012. The amount that they're going to repay on that day is $5,000. And it says that a couple of times on the document. It doesn't tell us how much they're going to get when they issue that, but that's something I'll come back to. This $5,000 is the principal amount. It's also referred to as the par value, the value at par, $5,000. The coupon rate is the rate at which this company is going to pay you regular interest. So per year, the interest rate is 6.5%. That's the interest rate. That's not the yield, but that's the rate at which they're going to pay us. And on this document, they're also going to tell us, a couple of things. They'll tell us how the interest is going to be paid, any special features. And there may be some other information that we're going to see a little bit later. And some of the key features that we've identified, first off, there's the par value. In the previous case, it was $5,000, and that's actually very common right now. Our textbook says, assume that the par value at maturity is $1,000. Well, most corporate issuers now issue bonds with a face value or a par value of $1,000. The coupon interest rate, stated interest rate. If you want to know what that is in dollars, we multiply that by the par value to get the number of dollars of interest. Typically, it's a fixed rate, but there are a number of different situations in which there are variable rates or rates that might fluctuate with inflation. Just come back to the previous statement. Stated interest multiplied by the par value. So if we have a 5% interest rate and $1,000 par value, that means they'll pay us $50 coupon per year. That could be paid in 2 installments of $25 or one payment of $50. Some of the other features of a bond: number of years until the bond must be repaid. Bonds are typically issued for durations of anything from a few days and weeks right up to perpetuity. They could be issued and only be redeemed when the company buys them back on the open market. In that case, we're talking about a perpetual bond or a perp. The maturity more typically is going to be 1, 3, 5, 10 years, 15 years, 20 years, up to 30 years. Although, as I said, it could be much longer, especially for some kinds of government bonds. Issue date is the date on which the bond was issued. And the default risk is the chance that the issuer is not going to be able to make interest payments or redeem the bond when it gets to maturity. That's something that we'll talk about a little bit later in this session. And here's another interesting example of an old style bond. In this case, it was issued by the City of New York. The purpose of the bond was specifically for new buildings for the College of the City of New York. It also says the par value is $1,000. And we've got some more information in print, too small for me to read, about the coupon rate and some of the issue conditions. Now, the interesting thing about this particular version is that on the document they give us two parts. Essentially, there's the big certificate that says $1,000, and for some reason it even says gold on it. I guess that's the series of this particular bond. It's considered to be a bond because it's issued for a stated purpose to provide a certain type of assets and implies that those assets serve as security for the bond. The coupons are actual coupons. They're attached to the bottom, and you can see that over the life of this bond, they're going to make 10 payments of, if it's a 5% bond, $50 per year. And so when it comes time to collect your coupon, in these older style bonds, you'd actually tear off one of those coupons, take it to the bank, cash it in, and they would deposit the money into your account. It turned out that some types of investors were particularly interested in the coupons, and yet others were not so interested in the coupons. They rather see the capital appreciation. The capital appreciation came from buying a bond at a low price and then redeeming it after a period of time at the full par value. For example, if I'm at a very high tax rate, if I receive a coupon payment, that becomes taxable income. And if I'm at a high rate, that means that I'm going to lose out that amount of tax. Also, if I don't need the cash to live right now, I have to find some place to reinvest it. And there'll be a transaction cost for that. It's pretty hard to reinvest $50 in bonds if the bond cost $1,000. So that wouldn't be practical for me. On the other hand, some investors really like to see those coupons. And sometimes we describe safe investments like this as being widows and orphans investments. We would sell these type of investments to people that needed the cash flow, pensioners, pension funds, for example, who need regular cash flow to pay their pensioners. And they would cash in these coupons and use the cash flow to make payments or to pay their bills. By identifying these two different types of investor, these two constituencies, we discovered something very interesting. That by tearing off the entire strip of coupons from the bottom of the bond, we could sell that strip of coupons to the people that needed the cash flow, and we could sell the part that had been stripped to somebody who needed the capital appreciation. And by doing that, we actually created a new product called strip bonds and strips, or coupon strips. And so these are actually traded separately because not everybody's looking for the same type of returns from their bonds. We'll come back to that examples of that and how we value that in a couple of minutes. Now, I'm unlikely to see a paper bond in my day-to-day transactions because most trading is done electronically. If I'm looking for bonds in a trading account, for example, this is a page from RBC, Royal Bank of Canada, and their online trading site, you can see that these are some of the options for a 5-year maturity bond that are offered by Canadian companies. We have companies or banks like CIBC or a food company called Alimentation Couche-Tard, West Coast Energy, Saputo, Union Gas, and so on. These are some of the typical corporate issuers. And of course, I've screened out the government issuers from this example. They also tell me the maturity date, and in this case all of these bonds mature in 2025, so they were 5-year maturity bonds. In fact, I screened for those. You can see there are a number of different coupon rates that are published. For example, CIBC has a 3.3% coupon, and that's right in the title of the bond. That tells you that the rate of return that you're going to get on an annual basis from the coupon. If they're paid semi-annually, you probably want to know what the yield is on a semi-annual basis. In this case, it's 1.27, which is interesting because that's not, twice 1.27 does not add up to 3.3. We'll come back to that in a minute. The next bit of information says that the approximate price, or basically the price the last time it was traded, was 109.84% of the par value. The par value on all of these bonds was $5,000. So if you wanted to buy this bond, you'd have to pay around $5,045 or $4,050 to buy the bond. It's selling at a premium to the par value. So it's not selling for $5,000, it's selling at 109.84 times the par value. And that's the money that we're actually achieving this 1.27% return on. So this is the yield on the actual purchase price, not on the par value. In the next column over, you can see we've got a number of ratings, and these are ratings that are provided by 3 different rating agencies, and the 3 best known in the Canadian market are Standard & Poor's, Moody's, and Dominion Securities. So the 3 ratings for the first one, CIBC, come in at AA, AA2, and A+, according to these 3 rating agencies. So they're all good ratings. And they say they have lots of inventory available to sell at Royal Bank. So there's so they've got 500,000 or more of that particular bond. In fact, you can see under West Coast Energy, we've got some interesting numbers. Their coupon rate is almost 9%. And you think about it, if you or I go to the bank, they give us 0.25%. If we invest in guaranteed investment certificates, you're going to have to work very hard to get 2%. How can they offer us an 8.9% coupon? Well, the answer here is that if you're going to get that kind of a coupon, you're going to have to pay a lot for that bond. The approximate price, $132 or 132% of that $5,000 bond price. The rating for this company is a low A or a triple B rating, and there's a little bit more detail underneath. It tells me what the approximate annual yield of 2.24, which is a fair rate of return for a triple B rated company. It tells me that the issuer is WTC, that's the ticker symbol for West Coast Energy. And if I want more information on this or any of these, I'm going to have to look at the company's prospectus. Now, a prospectus is a filing or a document that's put on display through a government agency. In this case, it's called CDAR in Canada. And so if I wanted to know about this particular instrument, I would see that they have issued, back in 2017, they issued $500 million worth of medium-term debentures, essentially bonds that are only secured by the good name of the company. And they do this on a regular basis. When I look at this database, I see they've got about 15 or 20 different preliminary prospectuses for preferred shares and for debt. Now, this document could be 100 pages long. It's got information on the company, information on the instrument, and all of the details about special features that may be part of the bond. One of those features is called a call provision. And so a call provision essentially means that the company can, under certain circumstances, force you to sell back your bonds at a certain price. That's a call provision. Essentially, they're calling their bonds back. It says the issuer can refund, and they're more likely to do that if interest rates fall and they find that they can reissue the bonds at a lower price. That's bad news for you because you like to receive the higher price. So there are a lot of conditions that are involved in this. Typically, the call price is higher than the par value. So there's going to be a premium that's going to be offered. And there may be a point at which the bonds cannot be called right away. They have to call them and then wait for a period of time. And it's called a deferred call. And the call premium declines as they get closer to that date. That's described as a Canada call feature. Another type of bond feature, and there are many, as many different features as lawyers can possibly think up. Another one that would actually serve the owner of the bond, the person who bought the bond, is that they can force the sale back of the bond under certain circumstances. And that's called a retractable or puttable bond. You have the right to sell the bonds back before maturity to the company at a preset price. It protects you from rising interest rates. In other words, if rising interest rates make it unfavorable to continue to hold the bond, you can sell back the bond and then use the cash to buy a higher yielding bond. Or if the company faces some kind of an event like a credit default or a fall in bond rating, that would also allow you to sell back the bond and reinvest in a different one. Another interesting feature that you may have heard about is a sinking fund. Sinking fund is one of those great terms that we use in finance that kind of associated with water. We talk about floating rates, floating rate loans, for example. We have liquidity and liquidity crises. And a sinking fund is essentially a term that describes a provision for a company to pay off a loan over its life rather than at maturity. If you have a mortgage on a house, you kind of recognize this feature because every time you make a mortgage payment, you pay interest for that period plus a portion of the principal. That's not normally a feature of either corporate loans or of corporate bonds. And so a sinking fund is basically a schedule that the company follows to partly repay its bonds in the years immediately before the bond matures. That stops the company from having to face a huge amount of principal repayment all at once, all at the end of the life of the bond. And if that high principal repayment was due, then it would threaten the credit quality of the company and the bond value would fall. The bond price would fall close to its end. Essentially, it works like amortization on a mortgage or a term loan. It makes it less risky for the investor, and it shortens the maturity of the bond. Essentially, a 5-year bond will be partly repaid in 3 years and 4 years, so that by the time you get to 5 years, has been substantially repaid. It may not be good for investors because, like a call provision, it means that the company is going to buy back some of the bonds. And if interest rates have fallen, then you might end up losing your bond before you get to the expected maturity. Usually sinking funds are managed two different ways. The company will decide to call a certain percentage at par per year, according to the series numbers perhaps. And so you might just find that you get a notice saying that your bonds are being called, and if you do nothing, one day you no longer have the bonds in your accounts. Instead, you have cash. Also, the company might decide to buy back its bonds on the open market, and that's a positive thing for all of the investors because it means that you have an opportunity to sell the bonds at the market price. It pushes up the value of the bond or the price of the bond for all investors. So essentially they would call a bond if the market rate of interest, the opportunity cost of debt or R sub D, is below the coupon rate and the bond sells at a premium. So at that rate, the open market we would use an open market purchase if the opportunity cost of debt is above coupon and the bond sells at a discount. There are an impossibly long list of other bond features. Some bonds can be converted into equity under certain conditions. So we call these convertible bonds. Usually this is at a fixed conversion ratio, and it's done on the offer of the bondholder at their discretion. Other kinds of bonds pay interest only when the issuer is in a condition to be able to repay the bonds. And real return bonds, the principal and or the interest can be indexed and protected against inflation. So those are some of the more common features. The second topic for today is about bond valuation. And bond valuation is about the timing of returns. Essentially, if you think about a timeline, starting off today with period 0, and let me just kind of highlight these timings. At time 0, we're going to buy our bond, and if it costs $5,000, then that would be, say, an outflow of minus $5,000. Period number 1, after a year or after 6 months, we're going to receive a coupon payment. That's an interest payment. Period number 2, another interest payment. Period number 3, number 4, number 5, and so on, right up until the last period, period N. So this timeline has a bit of a discontinuity in it. At time N, let's say that's in 15 years' time or 14 years' time, whatever our period is, we're going to receive one last interest payment, plus we're going to receive the principal repayment. And since we use P for other notation, we use M for the principal repayment. For every period from now until that day, we're going to have an opportunity cost of capital, a fair rate of return that we would get by investing in an equally risky debt instrument, higher than the risk-free rate that we would pay if we were going to, or the government would pay in order to get us to invest in a government bond, because of default risk and maturity premium and some of the other things we'll look at in a couple of minutes. So R sub D is our effective yield or effective requirement. It's not the same as the coupon payment, or at least it may not be the same as the coupon payment. So we're going to discount this coupon payment by 1 plus R sub D to the power of time, in this case period 1. Period 2, we're going to have the coupon payment discounted by 1 plus the discount rate squared to the third power to the fourth power, all the way through to the last period, period N. It's probably better to use an example to be able to see how this works. For example, if we have a 15-year maturity on a 10% coupon bond, and in this case our cost of debt is going to be 10%. The coupon is 10% of $1,000, and so that's why we've got $100 for interest payment. Period number 2, we've got another 100 payments. Periods number 3, 4, 5, all the way through to year 15. We're going to receive $100, and in year 15 we'll receive the $100 plus the principal repayment of $1,000. If we're going to discount that to figure out what the price today should be, the intrinsic value, would say we have $100 discounted by 1.1 to the first power, $91. Second period, we're going to have $100 discounted by 1.1 squared, and so on right through until the end period. In dollar terms, period number 1, 90.91. By the time we get to year 15, 100 divided by 1.1 to the 15th power only puts the value of that $100 in present value terms at $23.94. We're also going to receive our $1,000 par value, which will also be discounted with the same factor. That's $239. We add together all of those periodic returns, and we're going to end up with $1,000. That's not a big surprise, because here we did something that's a bit unusual. We used the same coupon rate as our discount rate. That's why we ended up with exactly $1,000. That value could be higher or could be lower, depending on the one thing that changes in this entire formula, and that's the yield on the debt, the R sub D. Here we said it was 10%, but things change constantly. For example, the risk-free rate, or the rate that governments set on debt, changes. The riskiness of the company changes when business conditions changes even if the bond rating doesn't change right away. So it could be 9.9 today and 9.5 tomorrow and 10.1 the next day. So that will change the value of the bond on a day-to-day basis. The coupon rate doesn't change, the par value doesn't change, the maturity doesn't change. The one variable that can flex is that cost of debt. Now that we understand how the coupon, the par value, and the maturity works, we can see why bond prices and the yield change. In this example, we have Shaw Communications 6.75 coupon bond with a maturity in the year 2039. The trading chart that is shown below for this particular bond shows that over a period of time, over this 1 month or several days during this month, the yield on the bond has gone up as high as $5.16, and then it's gone down to $5.07, back up to $5.16, and so on over the period of this month. The yield defines the price. In this case, the most recent price, when we had a yield of about $5.13 over on the right-hand side of the chart, gave us a price of $121.92 per $100 in the bond. Now remember, this is a $5,000 bond, so it's 121 or 122% of that $5,000. Whenever the market believes that the return is going to go up or the return is going to go down, the price changes. So every time the price goes up, the yield goes down, and vice versa. We'll talk a little bit more about that in a couple of minutes, but remember that relationship. As price goes up, the return, the yield, goes down. Now we're going to move over to the bond valuation and how bond valuation works. Essentially, we calculate the value of a coupon bond with semi-annual payments using the formula below. The value is going to depend on two major sources of value: the cash flows that we get from the coupon, the cash flow that we get from the principal. The first part of this equation, the first term, shows us that the value of the bond is going to be based on C, which is a coupon, which we're going to receive twice a year. So we're going to take the annual coupon rate and we're going to divide it by 2. It's going to be discounted at 1 plus the yield to maturity, R sub D, and because we're going to be taking this coupon payment twice a year, we're going to take the yield and divide that by 2. If we receive this once over the entire life of the bond, well, basically it is just that one term. If we receive it 10 times, then we'll need to repeat this term 10 times to the first power, the second power, and so on for each of those 10 periods. So the first part shows us the sum of all of the coupon payments for all of the time periods in which we receive those coupon payments. The second term is the principal, the $1,000 par value or the $5,000 par value, discounted at whatever the yield to maturity is for that very last period. If it's the second half of the 14th year, it would be 1 plus the yield divided by 2 times twice the number of compounding periods. So for 15 years, compounded twice a year, 2 times 15 would be 30 compounding periods. So 1 plus the yield to the 30th power. In this particular case, our one major unknown is the yield to maturity, or the required yield. And the required yield is essentially the current rate earned on a comparable bond with the same maturity and the same risk. So if I'm looking at Shaw Communications as my example, and they have a BBB rated bond, and this is a 15-year maturity, I could find another company, another telecommunication company, or any other non-bank organization, and if they have the same yield and the same bond rating, I could figure out exactly what the yield should be. We can see an example of this using a spreadsheet. This spreadsheet I've included in the VIU Learn category for this week, and I'll just toggle over to that. I can use that to see exactly how the valuation works. You can see that I've actually broken down and I've included that information in the first column. I've got my coupon, my yield to maturity, the time period for compounding, the par value or the principal value, and the number of compounding periods, n, per year. So plugging those numbers into this formula, I can figure out what the present value of the sum of all those coupons would be. That's the yellow box, the first yellow box. The second yellow box is the present value of the principal or the par value. And it's going to depend on the value of the coupon. So if this is a 6% bond on a $1,000 par value, that would be my coupon. And the green area represents an input or an unknown. The yield to maturity that I require from this kind of a bond, I've said is 10%. The number of compounding periods is 20, par value 1,000, and 2 periods per year. And you can see what happens if I change these numbers. For example, if my coupon becomes 10%, I would put in a coupon value of $100. As I change that, it's my coupon value, my coupon rate is 10%, or the same as my yield to maturity. So for this 20-year bond, $1,000 par value, the value of my bond, the peach-colored box in column D, says the value of this bond should be $1,000. The value is going to come from two different sources. Over the 20 years, I'm going to receive $858 in coupon, and I'm going to receive $142. That's the present value of $1,000 received in 20 years' time. What if the coupon rate went up to 110? If I calculated that, this bond now should sell at a premium of $1,085. And that's because the coupon rate of 11% is better than the opportunity cost, the yield to maturity. If I made that coupon rate 9%, well, now you can see that the yield to maturity is still 10%. Everything else is the same. But what changes now is that the bond will sell for $914. It sells at a discount to par value because the rate of the cash return that I receive is going to be below my opportunity cost of 10%. So this gives us an idea of how these things work. It also shows us something that is quite interesting. What happens if we have no coupon? What if we're one of those strip bonds that I talked about at the very beginning of this session? No coupons, we're only going to receive the final principal repayment. And that would say that this bond, or the stripped bond, should sell for $142.05. That would be the amount you'd be willing to pay for the strip. That means you buy it today, you hold on to it for 20 years, and in 20 years' time you're going to receive $1,000. You would pay $142 today to receive $1,000 in 20 years' time. It would all be a capital gain or capital appreciation, is taxed at a lower rate. So if you're one of those investors who's worried about taxes, this would probably be the better investment. If we have a $10, a 10% coupon rate, and that's going to give us a $100 coupon, and the par value of this bond in 20 years' time is going to be 0 because we're only buying the coupon strips, that says that we would pay $858, $857.95. That's the amount you'd pay to receive only the coupons, because they're going to give you $100 received every year, or $50 twice a year, for the next 20 years. So this gives us an idea of the breakdown between those two things. Here's an interesting example. What if you operate in an Islamic country where interest is considered to be undesirable, illegal perhaps? That means you can't have any coupon. And if you have a $1,000 par value bond, that would say that you could buy this bond for $142. You get a capital gain, which is considered to be okay, but you would receive 0 interest. This describes a Sharia-compliant bond, an Islamic bond with a 0% coupon. Something that's part of the fastest growing bond market in the world because of the increasing wealth in that part of the world. So this shows how we could use an Excel spreadsheet to describe a bond investment. It isn't actually how we calculate bond yields using Excel, and we'll come to that in a couple of minutes. So we've looked at yield to maturity. Yield to maturity is the most commonly quoted rate of return on bonds. It's essentially the opportunity cost for a bond investor. It's the promised compounded rate of return received from a bond purchased in the market and held to maturity, and it equates the present value of the expected cash flows from the coupon and from the principal from the original investment. Later on, we'll see what internal rate of return is, and you'll see it works pretty much like that. And you'll probably remember that internal rate of return is something that is very difficult to calculate with a pencil and a pen. So it's for this type of calculation, we're more likely to use our calculator. And if you have one of our BA2+ calculators, you'll see that this is something that we probably already know how to calculate. It's just a variation. For this calculation, and this particular example, we can use our Business Analyst 2 calculator, and I've got one on the front page of my slides. I'm going to use the buttons N, interest per year, present value, payment, and future value. You find those in the third row on the calculator. A couple of other buttons I'll need to use to do this. I need to use the compute button. I need to be able to change the sign. That's down here at the bottom, the plus or the minus. So if I start off with my calculator, the first thing I'm going to do is put in the number of years for this investment. This is a 14-year investment, so 14 becomes N. Click on N, and you'll see I have a little diamond above, or a little triangle above the number, which tells me that's been saved in a register. My unknown is the yield to maturity, so I'm not going to calculate the interest per year yet. I do know the price of the bond today in this example, and my price is $14.94.93. So that's the quoted price to buy this. And since I'm buying it, means I've got to use money. I need a negative number. It has to be a negative number in this chain of information. And then I'm going to click on the present value button, and that saved it as the present value. It's stored in the register. My cash flow, my payment, is going to be a $100 coupon. And so 100 is payment. I'll click on that. That's been stored. And the par value is the future value of the bond. So that's $1,000 I'm going to receive in 14 years' time. So click on future value. And all of that's been stored. If I've stored this properly in the register, I'm going to click now on compute, and it's going to tell me the yield to maturity. So compute, interest per year, and that tells me that the yield for this particular bond is 5%. And we say it sells at a premium because $1,494 is greater than the $1,000 par value. And the reason for that is that the 10% or the $100 coupon that we receive is above the 5% opportunity cost. So the bond's value is therefore above the par value. We can solve this for a semi-annual coupon by looking at that formula that we showed you earlier. We need to calculate the coupon rate, the present value of the coupon rate, and the present value of the par value. And we say here the investors are going to earn the yield to maturity on this particular type of bond if the bonds are held to maturity and all the coupons are reinvested at the current yield to maturity. So for this calculation, again, we would use a slight variation. We still have those numbers stored in the registered on the calculator. So 2 times 14 is 28. That would be our N. We're not going to have to change the present value. We already put that in. The price is still $1,495. The interest per year, or the coupon, is going to be $100 divided by 2. So that's 50 is the payment, and we don't have to change the future value. Now if I click on compute interest per year, that's going to give me a yield to maturity of 2.52, a little bit higher than twice the 5% yield to maturity that we'd receive per year, and that's because of compounding. You can also calculate this kind of thing with Excel, but we'd need more specific information. There's a function, and you'll see the function is given in this this particular help example. It shows us the function for calculating yield to maturity is equals yield mat, and I'd have to put in information like the settlement date, A2, the maturity date, specifically A3, the date the bond was issued, A4, A5 is the coupon rate in percent, the price as a percentage of 100 is A6, and then we also have to tell the computer whether or not we're going to have a certain number of compounding periods. For example, the standard for most bonds is to use a standard 30-day month and a 360-day year, rather than the actual number of days and the actual number of days in that particular year. So we would need this information. We don't have it in a textbook example, so typically we don't use yield to maturity when we're in a corporate finance class, but we would use it if we were a bond trader. Another term that's important to us is the yield to call. Yield to call is the yield to a specific call date. Remember, with the call provision, the issuer of the bond can recall the bond on a particular date with a certain amount of notice. So the only thing that we'd have to do differently with the yield to call is substitute the number of periods until the first possible call date according to the rules of that bond, and the call price for that particular bond. And with semi-annual coupons, our calculation of the price of this particular bond would be to use C as the call instead of N, so 2 times call. If that means, if for example, if we're going to call the bond in 10 years, we'd have 20 compounding periods. 2 times 10 would be the number of compounding periods. The coupon rate would still be the same. The call price would be substituted for the par value, because usually the issuer will pay us a premium above the normal par value. So if it's $1,000 par value, we could receive $1,050 as the call price. And then we would solve this for the yield to call instead of the yield to maturity, and that would give us the yield on this particular type of instrument. So the two differences, the time period and the change in the par value to the call price. So for example, if we have a 10-year call period instead of the 14-year, still have a 10% annual coupon, $1,000 par value, and the price is the same at $14.94, and we had a 5% yield to maturity, this bond could perhaps be called at a call price of $1,100. So if we're going to use this formula that we've just showed you, and on an annual basis rather than on the basis of having a semi-annual coupon, if we did the calculation for this one, 9 would be my N, because that's the number of years until my earliest possible call. $14.94, I've already put that in, but I'll do that again. 0.93, and minus is the present value. My coupon still remains the same at 100 payment, but here I'm going to, instead of have $1,000 for my future value, I'm going to have $1,100, because that's the call price. That's the extra $100 I get for allowing them to call my bond on that date. Now if I compute my interest per year, the yield to call becomes 4.21%. Now The call is something that's likely to happen, or more likely to happen, if interest rates are changing. So if interest rates are falling, the issuer is much more likely to issue or to use the call provision. If interest rates are rising, and it would be more expensive for them to raise money, they would never call the bond, or they would be unlikely to call the bond. So if our coupon rate is 10% versus the yield to call of 4.21, the company could reissue bonds and only have to pay 4.21% instead of the 5%. So it could replace the bonds, which pay $100 per year, with the bonds that only pay $42.10. So therefore, as an investor, you would expect a yield to call and earn yield to call rather than yield to maturity. So generally, we'd also say that a bond is going to sell at a premium. If a bond sells at a premium, the coupon rate is above the cost of debt, so a call becomes very likely. You would earn the yield to call on premium bonds and the yield to maturity on par and discount bonds. Bond price changes over time as the market recognizes that there are changes happening in the business environment. But over time, there is essentially a drift from the premium price or the discount price. Eventually, the bond price is going to reach the par value. So we say that in general, bond prices move opposite to yields. That's in the short term, that's one of the changes that we expect to see. If the market has a lower opportunity cost of capital because interest rates are falling, then bond prices rise. Yield goes down, bond price increases. If we expect to see a rise in interest rates, and we're fixed and we're receiving a coupon rate that doesn't change with that, then we'd see the bond price fall. So yields go up and bonds go down. Over the life of the bond, eventually the price is going to converge to the par value, because eventually at the end of the bond's life it can only be worth its par value. And so if you're on the top line on this particular chart, you can see a bond that's currently priced at $14.95 at a premium. Today is going to be worth that, but next year will be worth slightly less. And as we approach the maturity date in 15 years' time, eventually the price is going to move to the par value of $1,000. If you had a discounted bond with a very low coupon rate, that is going to still remain a discounted bond until we get close to the maturity date, and eventually we're going to move to that final price. So at maturity, the value of the bond can only be its par value. That's the amount that we're going to receive. The premium bond would decrease to $1,000. The discount bond would increase to $1,000 as you got closer to that final date. The par value will also stay at $1,000 if there is no change in the required yield, the yield to maturity. If the coupon rate that we receive is below the yield to maturity, the bond is going to sell at a discount. If the coupon rate is equal to the yield to maturity, it sells at par. And if the coupon is greater than the yield to maturity, the bond will sell at a premium. So as the yield rises, the price falls, and price always is going to equal par at maturity. Now, these are the things that we have to remember about the relationship between price and yield for a bond. So that's really why bond prices change. In today's session, we've covered a lot of ground. We started off by taking a look at some of the basic features of a bond. What do we mean by things like coupon rate, par value, yield to maturity? We looked at how some of those bonds are different and some of the special features in certain kinds of bonds, and later on we even introduced some of the other bonds like Sharia compliant or Islamic friendly bonds. We took a look at how to calculate the price of a bond using several different approaches. We looked at very briefly at the bond valuation process, and it's something we're going to look at later. We took a look at the calculation of bond yield, especially the yield to maturity and the yield to call. And we finished up by taking a look at why bond prices change. This is the first part of a process of understanding how bonds work and bond valuation. In a second stage, we have to understand how interest rates and interest rate markets work, and we'll also take a look at how we calculate the default risk. But stay tuned for those videos that are coming up next.